Home prices may be slipping in parts of California in 2026, but that does not mean buying has become safer. In fact, for many households, it has become more dangerous. Monthly payments are being crushed by interest rates, insurance premiums are exploding, and hidden ownership costs are rising faster than incomes can keep up. You can buy for less than last year and still end up paying far more over time. And when demand dries up, selling becomes the real risk. So before you make a move, you need to understand which cities are quietly turning homeownership into a financial trap. Which California city is making residents poorer, even as prices fall? The housing slowdown unfolding across California in 2026 is not a typical price correction. It is a structural shift driven by forces that did not exist or did not align during previous cycles. Prices are easing in some markets, but the foundations that once supported rapid appreciation have eroded. First, interest rates remain elevated far longer than most buyers expected. Mortgage rates hovering near multi-year highs have permanently altered monthly affordability. Even modest price reductions fail to offset the financing burden. For many households, the payment, not the price, has become the deal breaker. This has quietly shifted leverage away from sellers and toward buyers, but only on paper. In practice, many buyers are choosing not to participate at all. Second, migration patterns have reversed. During the pandemic, high-income earners flooded into expensive coastal metros, convinced that remote work had removed geographic limits. By 2026, that assumption has collapsed. Return-to-office mandates, job cuts, and lifestyle recalculations have triggered outbound migration from the most expensive cities. Inventory is rising not because builders suddenly accelerated, but because demand pulled back. Third, investor behavior has changed. Large investors and short-term rental operators once absorbed excess supply, stabilizing prices. That backstop is gone. Rising borrowing costs, weaker rents, stricter regulations, and falling appreciation have pushed investors into exit mode. As they list properties, inventory stacks up faster than organic demand can absorb it. But the most disruptive force is cost inflation outside the mortgage. Insurance premiums, especially in climate-exposed regions, have surged. In wildfire, flood, and heat risk zones, coverage is either extremely expensive or increasingly unavailable. Utilities, property taxes, HOA fees, and maintenance costs have also climbed. These expenses do not fall when prices fall. They compound. This is why the current adjustment feels different. Prices may soften, but ownership has not become easier. The growth narrative that justified extreme valuations has disappeared, while the cost structure remains unforgiving. That mismatch is reshaping behavior across the state, particularly in high-profile cities that once seemed untouchable. If you want clear, city-by-city breakdowns of how these forces collide in real neighborhoods, like the video, subscribe to the channel and turn on notifications. The next 7 case studies show what happens when affordability, demand, and confidence break at the same time. 1. San Francisco. For decades, San Francisco stood at the center of America's innovation economy. It was the place where ambition justified almost any price tag. Buyers accepted extreme costs because growth felt inevitable. By 2026, that logic has fractured. Median home prices still hover around the $1.3 million range, but the energy that once sustained those valuations is gone. Tech layoffs have reduced high-income demand. Remote work has loosened geographic loyalty, and outbound migration has thinned entire neighborhoods. Since the early 2010s, tens of thousands of residents have left, leaving behind rising inventory and a market struggling to clear. The cracks are most visible in the condo sector. Listings are sitting longer. Price reductions have become routine. HOA fees, often exceeding $1,500 per month, now function like a second mortgage. For many buyers, the total monthly obligation no longer makes financial sense, even with negotiated discounts. Sellers, meanwhile, are discovering that prestige alone no longer attracts offers. Outside the numbers, quality of life pressures compound the problem. Property crime remains a persistent concern, undermining buyer confidence. Public transportation systems face funding strain. reducing the convenience that once defined urban living. Insurance costs continue to rise, particularly for properties exposed to earthquake and fire risk, adding yet another layer of uncertainty to ownership. The result is a market where prices are not collapsing, but liquidity is. Homes are harder to sell, buyers are hesitant, and developers are shelving projects that no longer pencil out. San Francisco has not lost its global reputation, but reputation alone no longer supports its housing market. So what happens when a city built on future growth runs out of believers? And if demand doesn't return, who exactly is supposed to buy next? 2. Los Angeles. Los Angeles has always sold a powerful image: opportunity, creativity, reinvention. For decades, buyers accepted high costs because the city promised upward mobility and cultural gravity. In 2026, that promise is under strain. Median home prices remain near the upper end of the market, yet household incomes have not kept pace. The affordability gap is now one of the widest in the country. Monthly mortgage payments, pushed higher by elevated interest rates, routinely exceed what middle-income families can safely sustain. What was once a stretch has become a financial choke point. At the same time, ownership costs beyond the mortgage are accelerating. Wildfire exposure has driven insurance premiums sharply higher, with some policies doubling over a short period. In certain areas, coverage has become harder to secure altogether. Property taxes, utilities, and maintenance costs continue to rise, compounding pressure on already strained budgets. Market behavior reflects this stress. Homes are sitting longer, and price reductions are increasingly common across neighborhoods that once felt insulated. Inventory is building not because Los Angeles is overbuilding, but because demand is weakening. Since the early 2020s, tens of thousands of residents have left the city, citing cost of living, safety concerns, and diminishing quality of life. Crime and homelessness further weigh on buyer confidence, particularly among families considering long-term routes. Even historically desirable areas are seeing hesitation where bidding wars once dominated. Los Angeles still commands attention. It still draws talent and capital. But the housing market no longer operates on aspiration alone. When prices remain high while confidence erodes, ownership becomes a gamble rather than a milestone. So when people start leaving faster than new buyers arrive, how long can the market hold, and who absorbs the risk when it doesn't? 3. San Diego. San Diego is often described as one of the most desirable places to live in America. Sun, coastline, military stability, and a growing biotech presence once made the city feel insulated from housing downturns. By 2026, that assumption is being tested. Median home prices remain elevated, hovering well above what local incomes can comfortably support. Even high-earning households are now allocating an unsustainable share of their income to housing. Mortgage payments alone consume a large portion of cash flow, and that is before factoring in taxes, insurance, and upkeep. Insurance has become a defining pressure point. As wildfire risk expands inland and coastal erosion intensifies, premiums have surged. Some insurers have reduced coverage options or exited certain areas altogether, leaving homeowners paying more for less protection. These costs are not theoretical. They are monthly, unavoidable, and rising. At the same time, inventory is quietly building. Years of development focused on luxury condos and high-end suburban projects have collided with softer demand. Price reductions are appearing with greater frequency, particularly among properties that were once expected to sell quickly. The market is no longer clearing at the pace sellers assumed. Quality of life frictions add to the strain. Traffic congestion has worsened. Property taxes remain among the highest in the state. Population growth has slowed as affordability breaks down, especially for younger families and first-time buyers who once viewed San Diego as a long-term destination. San Diego still looks like a paradise, but in 2026, the math behind owning here is increasingly difficult to defend. When beauty and lifestyle can no longer compensate for financial pressure, demand weakens quietly, and markets follow. So if even California's most polished coastal city is losing affordability and momentum, what does that say about the rest of the state? 4. Oakland. Oakland was once viewed as the Bay Area's release valve, a more affordable, culturally rich alternative to San Francisco that still offered proximity to high-paying jobs. For years, that positioning supported steady demand. By 2026, the trade-offs have become harder to justify. Home prices remain high relative to local incomes, leaving buyers stretched even before factoring in today's interest rates. As financing costs climbed, affordability collapsed quickly. The result has been a visible shift in market behavior. Listings are sitting longer. Price cuts are increasingly common. Inventory feels heavy, but confidence feels thin. Safety has become a central concern. Property crime rates rank among the highest in the nation, and persistent reports of break-ins and theft have undermined buyer psychology. For many households, the risk no longer matches the price. Investors, once willing to tolerate volatility for appreciation, have begun stepping back. Ownership costs continue to rise in less visible ways. Insurance premiums have jumped, particularly in hillside neighborhoods exposed to wildfire risk. Some homeowners now pay dramatically more for coverage than they did just a few years ago, while others face reduced options altogether. These increases erode any perceived value gained from buying at a discount. Migration patterns reflect the pressure. Oakland has lost a significant share of residents since the early 2020s, as both renters and owners reassess whether the financial and lifestyle trade-offs still make sense. What remains is a market with growing supply and fewer committed buyers. Oakland's culture and identity have not disappeared, but housing markets are built on confidence, and confidence is fragile. When affordability, safety, and long-term upside all come into question at once, stability becomes difficult to sustain. So if the affordable alternative no longer feels affordable or safe, where does that leave demand? 5. Santa Cruz. Santa Cruz has long carried the allure of a coastal escape, creative, independent, and deeply tied to California's beach culture. For years, buyers justified premium prices by treating the city as a lifestyle investment. In 2026, that calculation has become increasingly fragile. Home prices remain extraordinarily high relative to local earnings. The gap between what homes cost and what residents make is among the widest in the state. For many buyers, ownership now requires devoting an overwhelming share of household income just to stay afloat. Even well-qualified borrowers find themselves financially boxed in from day one. Climate exposure intensifies the risk. Santa Cruz sits at the intersection of multiple environmental pressures: coastal flooding, erosion, and wildfire danger in surrounding hills. Insurance premiums have climbed sharply, and in some cases, coverage has become difficult to secure without supplemental policies. These costs arrive on top of already elevated mortgages, quietly transforming ownership into a high-stress proposition. Market signals reflect the strain. Price reductions are becoming more common, and homes are taking longer to sell than they did during the boom years. Investor interest has thinned, removing a key source of demand that once supported valuations. Younger families, in particular, are leaving in search of housing that does not feel financially suffocating. What remains is a city still rich in character, but increasingly poor in housing viability. The lifestyle Santa Cruz offers has not vanished, but the economics behind buying into it no longer work for most households. So when a market depends on dream buyers rather than sustainable fundamentals, how resilient can it really be? 6. Palm Springs. Palm Springs built its modern housing boom on a simple promise: sunshine, leisure, and escape. It attracted retirees, second home buyers, and investors chasing short-term rental income. For years, demand felt effortless. By 2026, the pressure points are impossible to ignore. Home prices remain high compared to local incomes, but the most immediate strain comes from the environment itself. Extreme heat has become routine, pushing cooling systems to run almost non-stop for large portions of the year. Utility bills have surged, turning basic habitability into a recurring expense shock. At the same time, water restrictions are tightening, and long-term supply concerns are no longer abstract. Climate risk has also reshaped insurance. Wildfire exposure across the Coachella Valley has driven premiums sharply higher, while more properties are being flagged as high risk. Coverage is more expensive, harder to obtain, and often less comprehensive than before. These costs stack on top of mortgages that were underwritten during far more optimistic assumptions. The housing market reflects the stress. Years of overbuilding, particularly in investor-oriented properties, have collided with a pullback in demand. As investors exit, listings accumulate. Price reductions are increasingly common, and average time on market has stretched well beyond what sellers once expected. Liquidity has thinned. Palm Springs still attracts tourists. That does not automatically translate into stable homeownership demand. When operating costs rise faster than income potential, the investment story breaks down. What once felt like a safe lifestyle play now carries ongoing financial exposure. So when heat, water, insurance, and oversupply all converge in one market, what exactly is supporting long-term value? 7. Santa Barbara. Santa Barbara has long projected an image of effortless wealth. Ocean views, Mediterranean-style architecture, and a carefully curated lifestyle made it one of California's most desirable coastal enclaves. For years, extreme prices felt justified by exclusivity. In 2026, that justification is beginning to erode. Home values remain among the highest in the state, far beyond what local incomes can support. Even affluent buyers are showing hesitation, not because they cannot afford the purchase price, but because the long-term cost structure no longer makes sense. Insurance has become a critical pressure point. Wildfire risk in nearby foothills combined with storm and mudslide exposure has pushed premiums sharply higher. Some properties now face limited coverage options or outright denials. Market behavior is adjusting accordingly. Homes are staying on the market longer, and price reductions are appearing with greater frequency. Demand that once felt automatic is now selective and cautious. Buyers are taking their time, aware that leverage has shifted. The deeper issue, however, is structural. As housing costs climbed, the workforce that keeps Santa Barbara functioning began to leave. Service workers, renters, and younger households have been priced out, straining restaurants, schools, and local businesses. A city can be beautiful and still fragile if it cannot retain the people who sustain it. Santa Barbara has not lost its appeal, but appeal alone does not guarantee housing stability. When ownership costs soar while population support weakens, even premium markets become vulnerable. So, if a city can no longer house the people who make it work, how durable is its housing market, no matter how beautiful the setting? Taken individually, none of these 7 cities proves that California's housing market is collapsing overnight. Prices are not uniformly crashing, and demand has not vanished everywhere at once. That is not the real story. The real danger lies in what these markets now share. Across San Francisco, Los Angeles, San Diego, Oakland, Santa Cruz, Palm Springs, and Santa Barbara, the same pattern keeps repeating. Prices surged on optimism, migration waves, and the belief that growth was permanent. Buyers stretched, investors piled in, and costs were tolerated because appreciation felt inevitable. That belief is now gone. What replaced it is far more unforgiving. Interest rates remain high. Insurance has become unpredictable or unaffordable. Utilities, taxes, and HOA fees keep climbing. At the same time, migration has reversed. Investor demand has thinned, and inventory is quietly building. Prices may soften, but the total cost of ownership does not. That mismatch is what traps homeowners. This is why the current adjustment feels so different. In past cycles, falling prices restored affordability and brought buyers back. In 2026, lower prices often arrive with higher monthly obligations and weaker confidence. The exit door narrows just as more people want to leave. The larger lesson is not about California alone. It is about what happens when markets are built on FOMO, leverage, and the assumption that prices only move one way. When those assumptions break, reality sets the rules again. So the question is no longer whether prices will dip further in certain cities. The real question is this: is this a temporary correction, or the beginning of a longer cycle where owning in the wrong place quietly drains wealth instead of building it? If this breakdown helped you see the risks more clearly, like the video, subscribe to the channel, and turn on notifications. And if you live in one of these cities or left one, share your experience. Because the next phase of this housing cycle will be shaped not by headlines, but by the decisions people make next.